Hello and welcome to this special edition on the state of the economy. We have got the inflation numbers for the month of September, and that has come in at 7.41. This compares with 7% in August, and it also compares with the CNBC-TV18 poll, which threw up 7.3. But to be fair, there were about 3 or 4 participants in our poll, or at least 30-40% of our poll respondents who expected a 7.4 or even higher. 7.41 is the big number. This is important because the September reading above 6% makes it the 9th consecutive month that inflation is above the Reserve Bank or the MPC's tolerance band of 2 to 6%. We have had a 6% plus for 9 months in a row, which requires the MPC and the RBI to write a letter to Parliament explaining why they failed to keep their mandate of keeping inflation within this bracket. They probably will also have to explain the steps they will take to bring it down to the mandate. That will be the next most important step. But for the moment, the worrisome point, the mildly worrisome point is that inflation is a little higher than what the street was expecting. It was not just our poll. Even the Informist poll was 7.3%. So a large number of people were expecting 7.3. To that extent, the number is a little higher than what the street was expecting. So the food price index has climbed by 0.9% month on month, and the overall headline CPI has climbed by 0.6% month on month. Now that can be high. Imagine a 0.6 for 12 months. 6 12s would be 7.2%. So a 0.6% every month, month on month, is not a very good number. Even without taking the compounding, it will become an over 7% inflation. So we would like the month on month inflation to be no more than 0.4. So 0.6 is a bit worrisome. I'll just give you a word on the IIP number. The IIP number has come in at, oh, that's a bad number. The August industrial growth number has come in, it's not a growth. It's a fall, industrial output contraction of 0.8%. Now, the CNBC-TV18 poll, I think, was expecting a rise of 1.8%. The Informist poll was also up 1.7%. So this also is a bit of a disappointment. But to be fair, the IIP has been an underestimation. Nevertheless, this is a bit of a worry that the IIP number is lower than expected. So, you know, what should be lower, inflation, is actually higher than expected. What should be higher, IIP, industrial growth, is lower than expected. So not a happy combination as far as the macro numbers are concerned. I'll try and give you a few more details on the inflation number. I'm sorry. Give me a minute. The vegetables index is the biggest culprit. It has risen 2.6% month on month. Oils and fats index, on the other hand, are the best numbers. They are down 1.9% month on month. Remember, edible oil prices had risen a lot in the wake of the Ukraine war, and this has been dropping for the past several months. I think what will worry the government and the RBI most is cereals and products index are up 2% month on month. 2% month on month is a very huge number. You know, again, if you extrapolate it to 12 months, you get an uncomfortably high number. Let me just try and read all the numbers in one go. Now, these are year-on-year numbers. Cereals and proteins are up 11.5%. This is year-on-year. Then meat and fish are up 2.5%. That's the good number. Eggs again up 7.13%. I'm sorry. Eggs is minus 1.79%. It's milk and milk products that are high. Milk and milk products are up 7.13%. Now, that is a bit of a common man's protein that has gone up a lot. Not to worry about oils and fats, which have been brought under control. Fruit has gone up 5.68%. Vegetables, the big culprit, up 18.05%. Of course, we've had unseasonal rains in October and in September, or a protracted monsoon withdrawal, which could have made up for this lack of supplies. And then we have fairly benign numbers on pulses. Pulses up just 3% year on year. Sugar up just 1.5%. Spices is up, but it's a small item, 16%. Let me come to food and beverages. Generally up 8.4%. Not a very happy number. Let's come to clothing and footwear. That again is a bad number, up 10.17. So this clearly is a bit of imported inflation as well. The housing number is up 4.5. That's tolerable. Fuel and light indicating some power tariffs also going up, 10.4%. And finally, we come to services. Again, a very important core inflation indicator. Household services up 7.6. Health up 5.5. Transportation and communication up 5.4. Recreation and amusement up 6.3. Education up 5.7. And personal care and effects up 6.8. More generally, services are up 6.06%. So I guess the core inflation is going to be a little stickier than previous months. Food inflation is up 8.6%. So core and food higher, not a very pleasant set of numbers. Let me get our guests in. Saugata Bhattacharya of Axis Bank, Anubhuti Sahai of Stan Chart, Abhishek Upadhyay of ICICI Securities PD, Rupa Rege Nitsure of L&T Finance, and Lakshmi Iyer of Kotak AMC are all with us. Ladies and gentlemen, thank you very much. Abhishek, you go first. This number is uncomfortable.
Latha, we were expecting 7.5, so more or less in line. But number is clearly bad. As you mentioned, headline inflation is of course high, very close to the April high of 7.8, which was the highest since 2014. Partly there is some base effect, but sequentially also the momentum seems strong. Food inflation again high, and it is being led by heavyweight segments such as cereals, milk products, prepared meals, where inflation pressures are typically sticky. They don't come down quickly once they pick up. And core inflation also, it seems, has printed at 6% this time from 5.9% last reading. So core inflation is not coming down either. So all of this suggests that inflation pressures will be slow to recede in the next few months. While global commodity prices have come down, but rupee has depreciated also. So it's not that input cost pressures will play a big role in inflation coming down quickly.
Fair point.
The only silver lining is high frequency data for October indicates cereals prices have come down a little, likely because of government steps. But we have to see how that evolves over the next few weeks.
Fair point. Saugata, what's your sense in terms of steps? Do you think now with a number like this and a note to write to Parliament, we should be prepared for some, more than 25 basis rate hikes down the line? Is it 35 or would you lean towards 50?
No, so thank you, Latha. To get to the point, 35 basis points. 50 probably not at this point in time. Remember, it's again food. So the old Hori saying that it has to be a coordinated set of measures because RBI doing a 35 or a 25 or a 50 is not likely to do anything to the complex of food prices. Core inflation remains a sticky point. We were estimating about a 6.2. If that 6% number is correct, I haven't seen. Then that's a little bit of a relief, but it's not likely to go anywhere anytime soon. So the monetary policy part will probably be targeted more towards the core inflation component. But even there, I mean, we have been hearing that pricing pass-throughs have continued apace. Aggregate demand conditions still remain fairly robust. Economic activity remains robust. So I think that's the part that the 35 that we expect is likely to combat. On the other side, all the other administrative, fiscal, agriculture measures, etc., are going to have to be deployed to try to do something on food prices. The good news is that I think you remember that September was always supposed to be the peak because of the base effect of last year. So from now on, it's down. Hopefully by March, we are going to see about a 5.7 or a 5.8%. Be that as it may, there are multiple assumptions underlying this crude at 100, etc. So if those remain true, then we are likely to see about a 5.1% inflation.
Fair enough. Rupa, where does this put us in terms of expectations here on? Do you think the Reserve Bank's 5.8% by the last quarter is intact? Or will you have to wait to see how October pans out before they can be sure of that number?
Yeah, first of all, even the second quarter, I would say that Reserve Bank was bank on its expectation.
Yes.
The number is ugly, but if you take the quarterly average, it is 7.04%. And
Yes.
RBI had said that 7.1% was its expectation. So in that sense, it is in line with their expectation.
In line with their expectation, yes.
Yeah. Then secondly, September in many ways, was an outlier, because we had too many extreme rainfall events. I mean, there was disruption to vegetable, fruit supplies, etc. And because of this whole, talk about rice sowing lagging behind, etc. And all, the prices of cereals also, on that speculation had started inching up. Personally, I'm not so worried about it, because first of all, government has taken many timely measures related to exports, etc. Our buffer stocks are also not in that bad situation. And, we have this fourth consecutively above normal monsoon season, which augurs very well for Rabi harvest. So I feel that, and there is rice sowing even during Rabi, there is a Rabi rice sowing. And, a lot of these northern states actually benefited from September rains, and they took some short duration crops of rice. And also that whole nervousness about food inflation, cereal inflation will ease in the third and fourth quarter.
Yeah.
And that combined with this thing, some moderation in global crude oil prices, I think inflation trajectory will pan out to be in line with Reserve Bank of India's expectation.
Okay. Anubhuti, may I ask you for your opinion on the IIP number? Actually, this looks like a bit of a double whammy. Not only is the August number a negative, minus 0.8, the July number has also been revised lower. From 2.4, it has been revised to 2.2. Okay, not a great deal, but the direction is not very happy. Would you worry that growth is kind of tiring out?
So to start with the August number, it's clearly much lower than our forecast of 1.4% and is disappointing. And if you are looking at it purely from the growth perspective, in Q1 of FY23, IIP averaged at around 13.8%. From there, we are clearly headed towards an average of 1% in Q2. So that would remain a drag on GDP. But if you look at the way GDP is computed, the EBITDA of companies, listed companies, once you exclude the oil and gas sector, looks very healthy.
Okay.
And as global commodity prices are coming off, there is some respite on WPI, especially when you're looking at it on a quarter-to-quarter
So
basis.
are you saying, therefore, the worst is over? Is that what you feel?
In terms of
growth slowing, I mean, we won't get a contraction hereafter.
No, I really, that would be slightly
overstated.
A very strong statement, just based on one data point, and given that we have just too many global uncertainties ahead of us. But the broader point which I'm trying to make is that IIP, as you already mentioned in your introductory comments, it's pretty erratic. What will matter a lot more is how the EBITDA, excluding oil and gas sector, plays out, and how WPI moves into a single digit. So I think that to some extent can offset a drag from IIP, which is likely to persist as we move into further quarters of FY23.
Okay. I'll just give you an idea of the internals. Internals are a bit disturbing. It's only electricity that has done well or come positive, 1.4%. Manufacturing is 0.7% contraction, minus 0.7%. And mining again has fallen 3.9%, minus 3.9%. So it's not at all a happy set, and it's particularly bad when you look at the use-based classification, because consumer non-durables, FMCG goods, when you say non-durables, they don't endure. These are soaps and toiletries, minus 9.9, and this actually gels with the kind of commentary we got from the Maricos and the Daburs, who have been saying, and even the Godrej, mid-single digits or low single digits in terms of growth. So this is not entirely an unbelievable number. This is usually bottom of the pyramid consumption, and therefore I think it would be worrisome. Also, -2.5 for consumer durables. That again comes as a bit of a surprise, but capital goods has done well, and that perhaps is a bit of a solace, up 20%. Lakshmi, before I go to the growth bit, do you think the market will react to this at all, or are we only looking at oil prices and US yields?
Well, Latha, we are looking at a combination of all of these markets. As you rightly observed, the consensus view was around 7.3 to 7.35. And towards the fag end of the market close, there was a reasonable good sell-off. Now, one can attribute that to anticipated inflation numbers, or UK yields going up, the 20-year bond yield going up, or the general jitteriness in the market. But I think it's a confluence of all these factors which currently are weighing in on bond yields, given that there is supply and there is no apparent durable demand. Yes, inflation coming at 7.4, to that extent may be neutral, but not really great news, given the kind of global headwinds right now which are plaguing the bond market.
Okay. All right. So, I mean, maybe this one will not be the reason why the bonds would move. Today, we also heard of some purchases by an Indian corporate, and that also apparently was supportive of bonds. Yeah, we have to see how US yields go. The global yield market is in a bad state, especially in UK and Europe. Coming back to the economists, Rupa, there are economists close to the Reserve Bank who believe that it's not September. September was a given at 7.4%. RBI knew that number before even the policy was announced. On September 30th, they had a good grip. But RBI would watch October very closely. If that doesn't fall as per expectation, that would be a bad outcome. But if it does fall, then, the Reserve Bank would perhaps not be unduly worried. Is that a fair observation, Rupa?
See, currently, Reserve Bank of India is not worried only about inflation, but it's also because of various spillover effects of the actions of global central banks and, their policies. So I think the actual magnitude of our rate increase will be decided not just by the domestic growth inflation mix, but also how what kind of action Federal Reserve takes in its next monetary policy. Because currently, I think stabilization of external sector and currency market is also an important objective before Reserve Bank of India.
Okay. Well, now I'll have to ask for some quick answers. Saugato, is growth a worry? Does the IIP worry you?
Growth is a worry. Growth is a worry in the sense that I'll tell you that in the GDP numbers, you remember that particular segment for Q1, the much lower than expected number for the trade, hotels and services restaurant, because that anecdotally we had heard that segment was doing well. There was a big kick-up. Apparently, it turns out that the NSO uses GST and based data to look at the small and micro enterprises, and that segment has not been doing well. My guess is that even the lower than expected IIP number is exactly due to that particular segment underperforming, and that's a worry. Because that's also a segment that is a large part of the consumption side of the GDP. So we need to understand this better, but that is my preliminary observation on the source of the worry for the growth. I'm not worried about the premium items. Demand, I think, will remain fairly constant, but this will show up in the volume-based quantities like you have in the IIP.
All right. Gentlemen and ladies, I have to end by taking a vote from all of you on what at the moment you are expecting in December in the form of interest rate action from the Reserve Bank. Anubhuti, A for Anubhuti first.
35 basis points with an upside risk, depending on how the US CPI comes tomorrow.
Okay, I got my alphabet wrong. Abhishek.
Yeah, 35 basis with the risk of a 50.
Okay. Rupa.
50 bits.
50. Saugato.
35.
Okay. I went with the economists first. Lakshmi.
35.
35. Okay. So the 35s have it, but there is a 1.5 vote for 50, I would say, with Rupa and Abhishek 1 foot in the 50 category. I guess The October numbers will be important. Will we get the October numbers? Yes, we will get the October numbers before the December policy. So the Reserve Bank has some elbow room to make up its mind. And of course, 2 months is a long time in global markets. Plenty of things can happen to the Reserve Bank. Thank you very much, all of you, for joining me in this conversation. Key takeaways: inflation slightly higher than expected, but should not ruffle the Reserve Bank because it's in line with their older forecast for the quarter. Secondly, IIP is the bigger worry, with the August number coming in lower than expected and July number scaled down from the earlier level by about 20 basis. Thirdly, now the decision is sealed, not that it was ever in doubt, that the MPC has failed in its to keep its mandate of keeping inflation within the 2 to 6% band for 9 months in a row. A note will have to be written to Parliament explaining. This is first in our lifetime, the first time it's happening after we adopted inflation targeting. So we will have to see how this is taken, whether it is made public and what kind of a weight it has on policy making. Does it disturb the MPC a bit too much, or will they take it in their stride given the unusual circumstances we are in with a pandemic and a war and unusual tightening, a third storm, as the governor called it. We will have to see how they take this forward, but this is certainly a first. On that note, we wrap up on this special State of the Economy edition. Stay with CNBC TV18. We have a very important guest joining us on the economy. We will have Reserve Bank of India former Governor Raghuram Rajan to speak about the turmoil in the global debt markets.